Portfolio Builder members, welcome to your 2/5/2020 update. First, we'll review our free portfolio, which actually sells for $1,000 a year, but you get it free for subscribing to this YouTube channel. And second, we'll review our high-end portfolio, where we add an extra layer of security trading options. First, the headlines: Chinese tech giant Tencent leaks 25,000 dead, 50 times greater than the official data. Then quickly they said that was an accident, put it back to the official data. This is the third time that's happened. Growth of the virus with official data in Asia is 10 to 30% day over day. It just takes 10% growth daily to double on a weekly basis, which means we are growing exponentially. We'll take a look at that in a minute. Have we reached the top in the stock market? I think yes. I believe we will top out by Monday, which would be very convenient for the U.S. Treasury that needs to sell $38 billion of 3-year notes Tuesday, $27 billion in 10-year notes on Wednesday, and then $19 billion on the 30-year next Thursday. And so again, if yields are going down, that makes the U.S. debt cheaper to finance. And so it could make a lot of sense why they used the futures market to gap stocks up tremendously in the last 48 hours. Now, in our buy and hold portfolio, we don't have the luxury of simply buying a put option to eliminate downside risk. So we have to use the TLT as our safe haven to protect our bullish SPY position. Meanwhile, central banks are printing money like none other, making the spot price on gold go higher, so we're long gold. Now, normally, we'd also be long 2 shares of emerging markets, but obviously, if China is going to shut down its country for a prolonged period of time, this will hurt their GDP and hurt their corporations. So the easiest way to do that with ETFs is the Yang ETF. Now, it's not the exact inverse of emerging markets, which gives you exposure to South Korea, Japan, Taiwan, and China, along with India and Russia. But it is a direct hit on the large cap companies in China, which are currently being supported by the Chinese government. So I do expect some drawdown in the Yang position as long as we hold on to it. But if the pressure mounts for long enough, certainly China's corporate sector is going to be hurt. Meanwhile, other headlines: Tesla tanked 20% today. Is this simply short sellers who had to cover exiting the position? Is it the start of a bigger sell-off? We will see. Again, we're predicting a upward move until probably Monday next week, and then I think it'll be convenient to see the news flow change to help the government sell its debt. Foxconn, a partner of Apple's and critical for its supply chain, is remaining offline for at least another week, potentially to the end of February, potentially into April. So far, this hasn't hurt Apple, but until it goes online, I'm going to be skeptical to go long emerging markets. And keep in mind, this is the first time in history that we've tried to quarantine 90 million people. So as long as China has everyone locked away in their houses, they have highways blockaded, we have problems ahead. Now, keep in mind, YouTube does not like controversial content. So if you want to get my uncensored views, you have to join the live webinar. And that is, again, part of our paid program, but we do give away a free 7-day trial. We're going to show you how to take this same portfolio, which you're seeing for free, normally sold for $1,000 a year, but now we're giving it away free as long as you subscribe to the YouTube channel. And you're going to see how you can add a tremendous amount of protection to downside risks through the option market. We can sell call options for income, buy put options for protection. And again, if you're looking at this video, in the right-hand corner, there may be an ad. If you don't see that, click in the description box, and you can get the sign-up link to our homepage, which will allow you to get on our email list and join our daily Zoom webinars, which have been going for 2 to 3 hours a day. And again, there's no censorship on the live webinar. So if you do want to get all the details on what's going on, check that out. But again, we are in a ratio of 1 share of SPY, 2 shares of TLT. We're using the TLT as the put. So that's what protects you from a sell-off in stocks. Meanwhile, I like gold miners, GDX, because the money supply is increasing dramatically. In fact, in the last 48 hours, I guess we're going on to 72 hours now, there was $250 billion added to the money supply in the US and China through reverse repo. So that's put a little bit of a pullback in the bond market as money flooded into equity markets, but I believe that will be short-lived. And again, we have $44 in cash on the side. Normally, I would have 2 shares of emerging markets, which cost about the same as the Yang ETF. But remember, Yang is a triple leveraged bear ETF shorting large cap Chinese companies. So you're really hitting their real estate and banking system the hardest with Yang. Whereas in emerging markets, we are more aligned with their Alibaba, Tencent, the semiconductor company in Taiwan, and then Samsung. Okay, so if we do scroll down, this is a review for folks who are in our paid program. And again, we have 2 levels in our option system. Some of you are just following the SPY. We're killing it on the SPY this year. If you're in the full program, we're currently long the TLT and GDX. And again, don't expect to pick up profits on the SPY and the TLT at the same time. It's a constant battle of money jumping ship from the stock market to the bond market. And as long as the Fed can cut rates, which they can, they're at 1.5, they can go all the way to 0, perhaps even lower, depending on what Europe does with their rates, and as well as what China does, which is currently expected to cut rates by 100 basis points. Well, bottom line is you want to own the SPY and TLT together to get a beautiful return with extremely low volatility. You can get the growth that your portfolio needs for retirement to beat inflation without the drawdown that you've seen in the stock market twice just in the last 2 decades of crashes over 50%. So these are our returns. We have a huge following that's growing rapidly. We've done a great job at simplifying investments and making your life safe and easy to pull profits out of the stock market. And in our option program, again, where we meet daily with a large group of investors, we have tens of millions of dollars following this very system. We're currently in about a $4 wide bull option collar that expires Friday. I'm looking for the SPY to get near 335 into new highs, just in time for the government to put out some negative news flow next week and sell off its debt, which will push TLT higher, SPY lower. So potentially look for a change up in the strategy next week, as I expect the virus data to become more and more alarming. And again, that's our plan. We're naked, the TLT and GDX, until China resumes business as normal, or at least starts to make moves in the right direction. Currently, they're going more constrictive, not less. And then we want to see the case count in Japan and US stop doubling week over week. It did double week over week. And so we could just be at the very beginning of an outbreak in other countries. Just as of recording this, the first case in Wisconsin was hit in the US. Now, we're using a bear option collar on emerging markets that has a 10-to-1 risk to reward ratio, so we can actually lose no more than $25 per contract and gain $275. We just need emerging markets to pull back a few dollars to hit that. Here is the spreadsheet I've set up to track this daily. So every morning, again, if you're on my email list, which you can click on the link below to get a free 7-day trial, you'll get a webinar invite each morning an hour before it begins. My co-teammate Dean starts off for an hour doing Q&A before I go on for about 2 hours a day, where we look at charts and review the current trade alert, which takes advantage of the option market. But again, I'm looking for the daily change to be less than 10% to show we are able to stop the spread of this virus. Now in the US, day over day, we did fine, except for, of course, one new case I just saw pick up from CNBC. So that would put this actually at 12 and actually show a bit of an increase, just under 10. So if we get 2 today, we'll be over 10%, and that's enough for exponential growth. You grow at a rate of 10% for 7 days straight, you double the caseload in a week. So in Asia, we're seeing growth rates that are above 10%. In China, we're actually getting data showing a growth rate of 100% per day. And over the course of the last several days, that has dramatically slowed down. The last update was only a growth rate of 20%, but that's still alarming. Thailand is growing at a rate of 31%, Singapore 33%, Japan a rate of 10%, just barely at that exponential rate, Hong Kong 23.5%, South Korea and Australia below 10%, and then everything else below there had a flat day over day. So mixed data, but again, it does look like the virus is growing and at an exponential rate. The chances of a vaccine being created are slim to none to fix this problem anytime soon. Probably, in the best case scenario, we're 6 to 12 months away from a vaccine. So that gives us a long time to worry about this virus and really requires that we see this start to slow down. In political news, last night we had the State of the Union address. Perhaps that's why the futures market was jumped up so dramatically. Haven't seen a move of this magnitude since the plunge protection team came in after the Christmas sell-off in 2018. Trump wouldn't shake Pelosi's hand. Looked like it was on purpose. It was kind of hard to tell if he just didn't see it. And then meanwhile, at the very end, Nancy Pelosi ripped up his articles. Is this all just show? Are they really just serving a small group of corporations, or do these two really hate each other? Sometimes it's hard to tell. We do know Jeff Bezos certainly does not like Trump and is best buddies with Bloomberg. Mitt Romney is going to vote guilty on the impeachment verdict, which is expected to be acquitted today. We'll see if we get any expectations. And now we can move our political fears to Pete Buttigieg is dominating. He is a great speaker and continues to surprise. Meanwhile, Bernie is also on fire. With Buttigieg, probably not a big risk to the markets. With Mayor Bloomberg, probably also not a risk to the markets. But Bernie is definitely a huge risk to the stock and bond market. At this point, I really don't see this as a huge risk to our portfolio, not until we get far closer to election. And again, if it's a race between Trump and Bloomberg, which is what I'm now expecting, either case is likely not a problem for stocks or bonds. Here's the headline over at Zero. First, Zero was blocked, or rather terminated from Twitter for linking to an article that's potentially had a theory that perhaps the virus was the SARS virus from 2003, which again we have never created a successful vaccine for 7 years later, but on steroids and mixed in with the HIV virus. So who knows if that's true, but they were accused of doxing the Chinese scientists, and their account was permanently terminated. The whole world of hedge fund and investors were pissed off and started retweeting their content, and now they have a new account up. So we'll see how long that one lasts. Carrie Lam Caves closes all Hong Kong crossings into mainland China. And this is after the entire medical team was boycotting working until this was accomplished. Now, I do believe you can get across, but you have to go into a 14-day quarantine. So we're still seeing China shut down and not open up, which makes me believe that growth will slow and central banks will react by cutting interest rates. First China, and then the U.S. should follow. That's been the trend. And now Twitter's suspended James O'Keefe. He's the one who's been getting undercover reporters into the DNC and into media companies and getting them caught on tape saying embarrassing things. And this is potentially the most alarming story of all, which again is Foxconn extends delays, won't restart iPhone production until late February. If that gets delayed into March and all of a sudden people can't buy iPhones, that could create a chaos situation all in itself. So this is one specific company we can watch for updates to get a feel for what's really going on in China. Cryptos are booming currently, which shows that there's not a lot of trust in currencies as banks are printing money, and that's central banks, to try to stabilize the economies and to boost GDP and protect markets. So we're seeing a nice big jump in Bitcoin and Ethereum, as well as other currencies, cryptocurrencies. Now, again, if you've been following us since last December, we've told you to hold a total 1% position in Bitcoin and Ethereum each, and anytime it goes over 1%, sell for profit, and anytime below, buy. No more than 2% exposure gives you a huge boost in return with very little risk, and this is something we still recommend. As long as central banks can cut rates lower, making the cost of money cheaper, and print, because there's low levels of inflation, you want to be long assets like gold, Bitcoin, and Ethereum. So in our portfolio, it's about 8% GLD, or rather GDX. We were playing GLD for much of the previous calendar year, and now we're long GDX. We'll look at a chart of spot gold and talk about how much money it costs to mine an ounce of gold. But right now, with spot gold well over 1,500 an ounce, the miners are making a nice profit. Okay, so here's your chart of gold. It may not ever go below $1,500. So that's the truth, because we have created such a massive amount of debt worldwide, some $270 trillion of government debt. The interest rates on that alone are going to force central banks to keep printing and continuing to devalue fiat currencies. Meanwhile, our ability to find the old barbellic relic and get it out of the ground is still at a much slower pace than we can fire up the old printing press. So again, if it costs $1,000 to mine an ounce of gold and it's selling for well over $1,500 to central banks who are trying to add credibility to their fiat currencies, well, you've got plenty of demand for a long time to come and a limited supply. So that's why we like to own GDX when spot gold is well above 1,500. Now the oil market is in serious trouble. If it goes below 50, many energy companies will go bankrupt. And so this is very alarming. So you can also see stocks are at all-time highs, but oil's at a multi-year low. Doesn't add up, does it? Now, again, if China is going to shut down huge chunks of its country to try to fight off a pandemic or an epidemic for them, well, is oil going to be going up? Probably not. So this is, again, a confirmation that growth is slowing, trouble ahead for equities. The method for resolving this for the central banks is to cut interest rates. That is, again, bullish for the bond market, for sovereign debt. And the best instrument for this is the TLT, which tracks that 30-year treasury. And that's the top shelf, best income product for sovereign debt in the world, bar none. Not only does it come with the best yield, right around 2%, if you expect the Fed's going to cut rates, and they have plenty of room to do so, that will drive the value of that bond significantly up. So you can get a guaranteed return plus the potential for a huge capital gain, flipping that bond right back to the Fed. And that's why people love to buy U.S. debt. Meanwhile, how's that soybean deal looking? Well, the futures market for soybeans is not spiking up. So, Now, we're already seeing tweets coming out of Twitter handles representing Communist Party in China saying that we need a little bit of breathing room to meet the trade deal because of this crisis, and that the U.S. should be helping them out here. And so we can see that the soybean demand is low, not high. Prices are falling, not rising. And this indicates to me that we will not see the Chinese accomplish the phase one trade deal in 2020. Now, will Trump aggravate this situation leading into an election? Probably not. What about the commodity-centric currencies such as the Australian dollar, the New Zealand dollar to start? Well, right when that phase one trade deal began, and we went from cutting rates to doing quantitative easing right around September, you can go look at any chart under the sun, and you'll see this huge pivot from where a reversal occurs right around August and September. I don't care what chart you pull up, you will see a major reversal changing the course of all action, price action, right there at that spot in time. And the narrative was that rate cuts are done, stock market is saved, trade war is not going to be a problem, growth will resume, everything's gravy. U.S. is going to extend a line of credit to China so they can do the Belt and Road Initiative. We can cash in some high-yielding bonds and go sell those worldwide, which our banks would love to do. Meanwhile, the U.S. gets to reduce the deficit by $200 billion and can show some healthy sales for different energy and commodity sectors, as well as tech and finance sectors in the U.S. So it looked great, but what the heck went wrong? Right around the turn of the new year, we had the Middle East light up and then the coronavirus break out. And so you can see this currency began to collapse. Now we printed $250 billion, injected into the stock market, trying to keep that narrative going. We'll see how long that lasts, probably not long. But we can see the Australian currency was strengthening from this entire narrative and then just began to tank once again. If we look at the big picture, it does not look pretty. And again, if we look at DXY in a little bit, that's the index, which has a huge weighting in the euro. But if we really focus on some of these commodity-based countries that should do very well if we really have a period of growth, and they're not. Here's the New Zealand dollar against the dollar, same general picture. The big picture is their currency continues to lose value against the dollar, which makes their debts harder to pay. And if we go to the 6-month view, once again, you can see that major reversal right around September, strengthening, and then right around the turn of the new year, this big demand for commodities started to dry up as China had to react to this crisis. Here's a chart of copper, illustrates the exact same concept. Dr. Copper is the nickname. Copper and gold tend to go up together at different times. A lot of people use that to predict treasury market, looking at the ratios of these two. But in general, if you have a period of pain coming up, look for gold. And if you have a period of growth, then we need copper. And people like copper over other energy assets just because it has such a demand in the electric vehicle space, which has now become the favorite topic of central bankers, talking about protecting the environment and how changing interest rates could somehow be a part of that. Anyway, right around September, when the stock market went on to skyrocket, the Fed stopped cutting rates and did QE. We have the exact same pattern. And again, we did a massive QE injection in the last 72 hours, and it did boost copper a little bit. But again, it's not solving, printing money does not stop a pandemic. It just does not. Shutting down a city won't be fixed by printing money. We need people to get to work and create productive uses of labor. And that's just not going to happen when you're in a 90 million person lockdown for who knows how long. We're closing in on the 2 p.m. Mountain Time or 4 p.m. Eastern market close. What I'm pulling up now are highlights from Twitter that are just hitting in the near term, right around the close of the stock market. And this fellow, Hu Jihin, is a CCP propaganda master, I guess. For Twitter's outlawed in China, but yet he's able to tweet all he likes. China is concentrating on battling the coronavirus. The U.S. government should be flexible on China-U.S. Phase 1 trade deal as a way to show goodwill to Chinese people working hard to contain the epidemic. I believe doing so will not harm President Trump's image among American public. Here's an interesting tweet from Tanner Brown. This is amazing and creepy, and surely I'm not the first to point this out. WeChat is, again, a very popular app in China. They don't even use email. Email's dead. They use WeChat, so it's more like a real-time email chatting app. And it makes a lot of sense. China has been ahead of the game on a lot of things of that nature. They don't use cash or even credit cards. They pay for everything with their phone. But it's just showing that he can post an image, which you might think would be able to get past censors. But oh no, they can take an image, scan it, read the words, and even translate it into different languages. So I've noticed lots of censorship getting worse and worse by the year for the past several years. And I do believe this will be a trend to keep a close eye on going into the future. Piece of good news, the U.S. CDC says 206 persons have tested negative and 76 more patients remain under investigation for the virus. A doctor at Wuhan Union Hospital said the hospital forbade them from disclosing that 14 medical staff had been infected with the virus after performing brain surgery on a patient who showed no symptoms. Nobody was allowed to mention the outbreak. Hugh Heijin, President and House Speaker, can't even shake hands. House Speaker also openly ripped up a copy of the President's State of the Union address. Partisan fighting has seriously eroded political ethics of the U.S., which will such a country respect international ethics? This is a question. Actually, that's what makes our government so powerful. It's this constant fighting back and forth that keeps the other in check, at least supposedly. Regardless, it's clearly the best model compared to other countries where one person makes the call and that's it, like China. Now, it's been hard to catch news clips from Twitter in terms of photos and videos in China. Here's a new one that just posted an hour ago. Wuhan Evergreen Community, a suspicious infected is being chased by a group of policemen. People are reluctant to go to the designated Fire God Mountain Hospital because it is like jail. You never know if you can still come back. Reaction tells everything. That's what your body does when it's suffocating. Now China's cracking down on false information being disseminated by Chinese. And you can see amid the outbreak of the deadly virus, CCP censorship involves into cell phone checking and arrest. 2 Wuhan people were caught in Hainan. Policemen checked their cell phones and they were asked to delete some pictures. Then both were still arrested. Disinfection scene. Chinese police forcefully capture people from the street who potentially have the virus.
真的没事。
An infant in Wuhan has tested positive for the coronavirus 30 hours after birth, said the city's children's hospital, raising concerns infection could be through the womb. A Wuhan doctor's conversation leaked. Okay, this will be the last clip. And again, the virus supposedly looks for an entry point when your throat gets dry, jumps into the throat, infects the throat, creates a cough. Then the virus begins, then it works its way into your lungs. Once it gets into the lungs, it's going to inflame the air sacs so that you can't transfer oxygen to your blood, and then you essentially suffocate. And so I'll just play this. We can. As the body runs out of oxygen, it does the shaking until you die of no oxygen. And at the end of the clip, he does go still. Okay, guys, the market just closed. Let's take a look at our positions and charts. So we're long the SPY, and we had quite a nice rally. Let me pull it just to normal. And again, I'm looking for this to basically hit this trend line, which is where the blue area ends, maybe poke its head above, and then to see negative news flow coordinated to help the government sell its debt next week. And the bulk of our long-term debt obligations will be fulfilled at the start of each month, typically, and certainly next week. So, again, it will be in their advantage to have another little sell-off and drive some fear into the market so we can sling this debt to foreigners and not bog down JP Morgan, who again, has ran out of cash, and that's why we had the whole repo madness hitting all the headlines and oversubscription this week, potentially from short sellers in Tesla having to cover their positions. So we have a nice gain. We went long this position and are already seeing a very nice gain. We were long at the start of the day. Let's just zoom in. So we jumped into this position right at noon and are up considerably. But again, we have the 330 put, so nothing to worry about if shit hits the fan between now and Friday. And we benefit all the way up to 335, and that is, again, in our option program. Now, by Monday, I will be tempted to do a setup where we can lose extremely little by owning the SPY, selling a deep in the money covered call, and then buying a cheap put, maybe even a little bit more expensive put, as I believe that we're going to see a lot of negative news flow next week, maybe even over the weekend, and a sell-off in the SPY, as well as a push-up in the TLT, which again will help the government sell the debt, which our central bank's not buying. We're buying the T-bills, we're not buying the notes or the bonds. So that we really want to sell to foreigners, and the best way to do that is when there is a crisis. So again, I would not be surprised at all if we have a sell-off in the SPY next week and that jump in the TLT, which again our highest level members have been holding on to as we track this crisis unfolding. Now here's a look at the TLT, and again I've created the same pitchfork for some trading ranges to look at. We're hitting the bottom of where I think the TLT should bottom out at. Maybe it'll dip below that trend line. Most likely no lower than 141.50, 140. I'd be shocked before we see a vicious jump to the upside. And when we look at the big picture of what's going on in the TLT, it can really parabolically move higher from the Fed cutting rates. And again, we have some room. It's at 1.5 to 1.75 federal fund rate. And their go-to strategy for saving the stock market is really just to copycat what China does. And China started off with a big punch of $180 billion printing, jumped into their financial system, saved the stock market. They outlawed selling stocks on all kinds of things to try to protect their corporate sector. And now I believe they will come in with at least a 1% cut in their interest rates. So typically the Fed will copy that shortly after, which will drive the TLT higher all on its own. But add in a global pandemic that's starting to grow exponentially over the next few months, then this could really, really jump further. We could see the Eurozone going from slightly negative interest rates to highly negative interest rates. And if that happens, then we might go into this bizarre world where the United States potentially goes below zero, which would bring us to potentially higher top target than I suspected possible last year at least. All right, guys, this is a pretty long video. I'm going to go ahead and close it out with the DXY dollar index. As you know, 98 was my line in the sand. To start off the year, we didn't know there was a virus that was spreading at such a exponential growth rate, and I was expecting the TLT to tank back to normal interest rates, which would help support the government's huge debt load this year and help take some of the pressure off of the U.S. banking system, and that we'd see emerging markets and the SPY travel higher together, and that we'd also still be long gold, expecting a whole bunch of quantitative easing this year with government spending more than they bring in. So they're creating deficit, which is forcing their central banks to increase the money supply. But right out the gate of 2020, we had the Middle East incident. We saw emerging markets selling off while SPY was going up, and we saw the dollar strengthening. So I knew there was something wrong in China, just didn't know what or why. The Phase 1 trade deal was great. They were going to get the banking system to finance the Belt and Road Initiative and pick up their bad loans. We were going to invest in this $1 trillion a year project to put their folks busy to work, and we do know they can build. Just look at the hospital they built in 10 days. But everything was going the wrong direction for emerging markets. So this was our first alarm, and we pivoted last Monday when we saw these growth rates initially at 100% growth per day. It slowed down, but it's still at a rate that would double on a weekly basis. So that's our update for today. Thank you guys so much for listening. Stay tuned for our next update right around the close tomorrow. And don't forget to click the link below so you can subscribe to our non-censored content. Join us live in the Zoom meeting. Take the options trade. During a bull market, buy and hold works well. But when you want to start shorting markets, inverse ETFs just don't do the job the way the option market does. And it doesn't protect you the way the option market can. You also can't sell call options for income, so there's some huge advantages. And I think over the course of 2020, you're going to wish you had our option trades layered on top of these core assets that we recommend investors hold to build a weatherproof portfolio. And also keep in mind, the whole idea of being long stocks and bonds only works for a little longer. Once the Fed does get to zero, there's very little room for them to go further. So they could keep it at zero for a while and just artificially keep yields low. But all of a sudden you have a government deficit problem that piles up very quickly. So I'm afraid we're getting to the end of the rope for federal policy to keep bubbling up assets. And the next thing we're going to see is runaway inflation like the 70s and rising rates. So we may be a couple years off from that. There's certainly going to be a lot of volatility in 2020 going into a heated election. And again, this whole growth narrative recovering in 2020 is looking less and less likely by the minute. So I wish the best for the Chinese people, and I hope they can get this contained. I wish the best for the rest of the world and that we can stop the growth of this virus. We'll be tracking it daily. And again, in that email inviting you to our webinar, we'll update those figures so you can be the first to know. Okay, thank you so much, and see you tomorrow.